Hi Adarsh, I hope I'm audible to you.
Yes, ma'am. Good morning.
Good morning. Video audio clear?
Yes, ma'am.
Yeah, perfect.
हर इमारत, हर घर एक ही चीज पर टिकी होती है, मजबूती। और मजबूती संयोग से नहीं बनती, मजबूती सोच से बनती है। सोच जिससे देश आगे बढ़ता है, सोच जिस पर मजबूत भविष्य खड़ा होता है। हम हैं बालाजी ग्रुप, कंक्रीट टीएमटी एंड स्ट्रक्चर्स। 1988 से बालाजी ग्रुप और कंक्रीट टीएमटी एंड स्ट्रक्चर्स ने स्टील निर्माण के क्षेत्र में लीडर के रूप में अपनी पहचान बनाई है। हम उस विश्वास की पहचान है जिस पर एक्सपर्ट्स भरोसा करते हैं, क्योंकि हम गुणवत्ता में बिना किसी समझौते के काम करते हैं। चाहे रॉ मटेरियल हो या फाइनल प्रोडक्ट, हर स्टेज में इन्हें जांचा और परखा जाता है, क्योंकि हम जानते हैं कि मजबूती से समझौता नहीं किया जा सकता। इसलिए हर बैच की कड़ी टेस्टिंग होती है। हमारी टीम हर प्रोसेस पर रियल टाइम नजर रखती है। हमारा टीएमटी एंड स्ट्रक्चर्स प्लांट आईएसओ और बीआईएस द्वारा मान्यता प्राप्त है। अत्याधुनिक मशीनें, सटीक कंट्रोल सिस्टम और इंजीनियरिंग का अनुभव, यहां हमारे प्रोडक्ट्स को भविष्य के लिए तैयार किया जाता है। कंक्रीट टीएमटी एंड स्ट्रक्चर्स मजबूती का सिर्फ दावा नहीं करता, बल्कि मजबूती साबित करता है। जब तक स्टील हमारी कसौटी पर खरा ना उतरे, वो आगे नहीं बढ़ता। हमारे कंक्रीट टीएमटी ब्रांड की मोहर हमारी शुद्धता और आपके भरोसे की पहचान है। कैंपस के अंदर मेडिकल सुविधा, ताकि हमारी टीम हर दिन सुरक्षित लौटे। नई सोच और जिम्मेदारी के साथ कंक्रीट टीएमटी एंड स्ट्रक्चर्स अपनी क्षमता और नेटवर्क को लगातार बढ़ा रहा है। इस साल हमारा लक्ष्य स्टील इंडस्ट्री में बेमिसाल क्वालिटी के साथ प्रोडक्शन के नए मुकाम हासिल करना है। कंक्रीट टीएमटी एंड स्ट्रक्चर्स, मजबूती ही हमारा विश्वास है।
Good morning, ladies and gentlemen, distinguished speakers, delegates, industry leaders, partners, and friends. I am Adarsh Pandey, host for today's session. A very warm welcome to Day 3 of World Metals and Mining Summit 2026. Over the last 2 days, we have explored the foundations of the metals and mining industry, from raw materials and ferroalloys to steel markets, operational excellence, and leadership. The insightful discussions and diverse perspectives shared by our speakers have reinforced one important message. Our industry is evolving faster than even before. Before moving forward, I would also like to thank all our distinguished speakers, partners, sponsors, Concrete TMT and Structures, Enlight Metals, GKTMT, Bhagwati Group, Hira Ferroalloys, and RSFA Metalics. Our supporting associations, IFA, SUFI, IFAPA, SMAM, and CGSRA. Our knowledge partners, Questro, Steel Network, and iEnergy, as well as our marketing partners, Steel Trade Info Services and Metals Buy, and all the delegates who have joined us to make the summit a success. Going ahead today, we take that conversation a step further by looking beyond domestic markets and focusing on the global landscape that is shaping the future of steel industry. From international trade and supply chains to digital commerce and artificial intelligence, today's session will explore the opportunities and challenges that will define the next phase of our industrial growth. We are honored to have us an exceptional lineup of global experts, industry leaders, and technology pioneers who will share their knowledge and experiences throughout the day. With that, let's begin our first technical session. Global steel market and trade outlook, India, China, and emerging opportunities. Let me set the context for this session. The steel industry has never been more interconnected than it is today. A policy decision in one country, a change in demand in another, or a shift in global trade flows can influence markets across continents within weeks. As the world's largest steel producer, China continues to play a significant role in shaping global market dynamics, while India is rapidly emerging as one of the strongest eminent growth engines for the future of the steel industry. Understanding these evolving global trends is essential for business seeking to remain competitive, resilient, and future ready in an incredible, increasing, interconnected world. Introducing the speakers to discuss these developments, we are privileged to have us an eminent panel representing the global market intelligence and international industry perspective. Our first distinguished speaker is Mr. Hong Mi Lee, independent bulk commodity consultant, Singapore. Widely respected for her expertise in China's steel and bulk commodities markets, he brings deep insights into the factors influencing Chinese steel production, demand, and global trade. Joining us from Egypt, we are honored to welcome Mr. Hossam Abdel Halim, who is advisory board member of Steel Network. With extensive international experience across the steel sector, he brings valuable perspectives on regional markets, global trade, and emerging opportunities. Now, we are equally delighted to welcome Mr. Sami Mohammed, who is board member, Steel Network Belgium. His understanding of the Europe steel industry and international market developments provides an important global perspective to today's discussions. Now, let me introduce you with moderator. Moderating today's session is Ms. Sakina Rizvi, who is Senior Business Analyst at Bigmint. With her extensive work in the steel market research, pricing intelligence, and global trade analysis, Ms. Rizvi has closely tracked developments across international steel markets. We are pleased to have her lead today's discussion. Ms. Rizvi, thank you for joining us, and the session is now yours.
Hello, everyone. I will very briefly walk you through global steel markets and trade outlook, India, China, and emerging opportunities. Let me just give you a quick introduction to Bigmint first. So, Bigmint is a trusted platform for price reporting, market intelligence, and consulting for commodities. We enable critical market decisions through robust pricing benchmarks, data analytics, and industry networking. Our assessments are derived from diverse market participants using globally benchmarked and compliant methodologies. Starting with my presentation now, the crude steel production, global crude steel production totaled 1,850 million tons in CY25 as per the data from the WSA. The decline was expected with output from China, the largest producer accounting for over 50% of the world total, falling by 4.4% to a 7-year low of 960 million tons. Moreover, several leading producers, including Japan, Russia, and South Korea, also recorded modest declines, struggling with weak demand and sluggish economic growth. Coming to the global steel exporting regions, the top 10 global steel exporting regions shipped 240 million tons in CY25, a modest 3% uptick from 232 million tons in CY24. China was the obvious growth driver with a 9% increase, while Turkey, Russia, and Brazil also recorded double-digit hikes. On the other hand, arrivals into the top 10 importers remain stagnant year on year. The Europe, Turkey, Thailand, Indonesia, and the Philippines recorded robust upticks, which were balanced by declines in the US, Vietnam, South Korea, Mexico, and India. Now, talking about China, China's steel exports reached a record high of 119 million tons in CY25, easily surpassing the earlier peak of 112 million tons in 2015. The Middle East and Africa region emerged as the largest importer of Chinese steel, with total arrivals into the region increasing by 14% year on year to 37.6 million tons. Top importers in the region were Saudi Arabia and the UAE. Coming to the Indian market, India's steel exports climbed up by 4% year on year to 8.59 million tons in CY25, and the minor 4% increase also marks a sharp turnaround from the first half of the year, during which export volumes were down by 25% year on year. The second half of the year saw shipments jump by 47% to 4.96 million tons, as Europe-based importers accelerated procurement ahead of the start of the CBAM. Shipments to the UAE increased by 25%, led by significantly higher purchase of HRC plates and pipes and tubes. Meanwhile, exports to Saudi Arabia declined by 79%, as India's pipes and tube shipments to the country tapered off from September 2024. Talking about the European market, the European Union has announced new steel safeguard quotas and country-specific steel import quotas that are expected to reshape global steel trade. Under its new steel regulation, the Europe has reduced total quotas by around 47% from the previous safeguard regime, while increasing the duty on out-of-quota imports to 50% from 25% for 26 steel products. Global steel and raw material prices also declined month on month in June 2026 across major markets, halting the sustained uptrend since the outbreak of the US-Iran conflict and the resulting Middle East crisis. With that context, I look forward to exploring these themes further during our panel discussion. But before the panel discussion, I invite Ms. Lee to give a brief overview on the China steel industry.
Okay, thank you. Thank you very much, Sakina. Happy to see everyone over here online. From my side, actually, will be very brief overview. So I'm not going to share any PPT. First of all, China's economy, China's GDP growth is set at 4.5%, slower than last year's 5%. And then if you're looking at the steel products, China's crude steel production declined by about 4%, as well as the finished steel. So they are kind of aligned in trend, which means that the inventory build-up to some extent has been curtailed in China. And but if you look at China's domestic demand for steel, it coming down as well. But it's not only about the coming down in volume. If you're looking at the volume, they're definitely coming down. But if you're looking at the quality requirements, definitely they are requiring higher value-added products. So I think for China, it's not only looking at the volume, it's more about restructuring of the steel demand structure. That's very important. And if you look at the steel exports, China declined, the number declined by about 8-9% until May, which shows the slower growth. Of course, I mean, it's still kind of, quite high, quite concerning to the other countries. But looking at the trend, it definitely going into the downtrend. I would say that 2025, very similar to 2015, that was 10 years ago. It was a kind of phenomenal year, which could be it's just a kind of individual case, I would say. And other than that, if you're looking at China's overall, the three pillars of the economy, normally China will be looking at the investment, consumption, as well as foreign trade or net trade value. So this year, so far, the foreign trade, including imports and exports, have been performing rather strongly, which lending support China's economic growth. And if you're looking at the imports, just at the value part, I'm looking at the RMB. Imports definitely grow faster than exports, which means that China has been doing this mutually beneficial deals, which is more like kind of a give and take. So China sending things out, but at the same time importing products from overseas as well, trying to, I wouldn't say it's kind of correcting the surplus, but at least it's trying to showing a very friendly front with the other countries. Like we sell something to you, but at the same time we're buying something from you as well. So for China, the economy is not only looking at the value or the volume anymore. I think starting this year, it will be the restructuring year, the evolution, some people I think are talking about transition, but I think it's definitely more than transition. It's almost like evolution. So the economic growth model has been shifting together with the steel market is going to plateau, as well as restructuring the supply models as well. Yeah, so that's basically from me, just a few highlights about the market situation in China. Thank you.
Thank you, Ms. Lee. Now, moving to our panel discussion, we saw that global crude steel production during Jan to May stood at 773 million tons. So, do you believe the industry is once again entering a structural oversupply phase, or do production discipline and trade measures provide enough support to rebalance the market? Ms. Lee, if you could start first.
Yes, sorry, I just unmute myself. From the past many years, decades of the development in the global market, I would say the market force itself will be able to doing the rebalance, because I think for the time being of looking at a supply structure, part of the reason is because a lot of anxiety and concern. You don't know, the global trade situation has improved so much, geopolitics and everything. You don't know how much you need and how much you can buy from overseas. So there definitely, under all these concerns, there will be some, I'd rather produce more than less, just in case. But I believe the global market as well, the global trade itself will be sufficient to correct itself. Yeah, thank you.
Mr. Abdul Halim, your highlights on this? Mr. Abdul Halim, I hope I'm audible to you. Anyways, Mr. Mohammed, if you could share your thoughts on this.
Good morning, everybody. Thank you very much for having me, and thank you for the organizer. Thanks, Sakina, for the introduction and the good overview, and Hong Mei about China. We are starting with China and India. It's very interesting for us in Europe to hear those introductory sessions today. Regarding the oversupply in the international market, I believe it's one of the complex topics. I believe the industry is definitely facing an oversupply risk again, but I would define it as regional oversupply with global consequences, of course. The global number itself is important. May crude steel production was, as mentioned, 773 million tons. Okay, down 0.15 year on year. So production is not growing aggressively everywhere, but the real problem is that the demand recovery is uneven. China remains under pressure from property and construction weakness. Europe is still soft, while India and parts of emerging Asia are growing. So the issue is not only how much steel is produced, but where the steel needs to go. It's very important, of course. When domestic demand is weak, mills protect utilization by exporting, and that creates pressure in third markets, especially South East Asia, the Middle East, and Africa. And we see this on the daily operations and the daily deals, commercial deals that that we do. So trade measures can slow the flow, but they rarely solve the fundamental imbalance. They redirect funds. Therefore, unless we see stronger demand recovery or more disciplined capacity utilization, oversupply pressure will, according to me, remain a key theme into the next year. Thanks.
Yeah, Mr. Abdul Halim, your short, brief view on this, if I'm audible to you. I think we should move on to the next question. So, it has been observed that flat steel prices have remained under pressure in recent months despite continued volatility in the key raw materials. So, why are finished steel prices failing to reflect raw material movements? Is weak demand now a bigger price driver than production cost? Mr. Mohammed, if you could answer this.
That's an interesting question. I just came back a month ago from Turkey discussing the same topic with our European partners and also people from the Middle East, which is a surprise to the steel community, of course, but it's understandable. In normal market conditions, raw material movements should be reflected in finished steel prices. But today, the transmission mechanism is weak because demand is the dominant driver. Uh, Flat steel prices are under pressure because buyers are not chasing material. We see this especially in the trade between Turkey and Europe, and definitely it's in other trade lanes. Many service centers and end users are buying hand to mouth. Inventories are being managed very carefully, and there is enough important availability in many regions. In that situation, even if iron ore or coking coal moves up, mills cannot fully pass through the cost increase unless demand allows it. The second point is very important. It's the competition. Flat steel is highly tradable, and if I go back to the presentation of Sakina, when we talk about China to exports to the rest of the world, we see the how the volume to the Middle East and Africa is huge. When Chinese, Indian, Turkish, Korean, or Vietnamese offers are competing in the same destination markets, the buyer benchmarks against the lowest credible import offer, and not only against the producer's cost curve. We have seen this ourselves in a lot of countries like Saudi Arabia, UAE, and other countries, also in Africa, North Africa, or even East or West. So yes, in the current market, weak demand is a bigger price driver than production costs. Costs still matter because they define margin pressure and mill discipline, but demand and import competition are setting the price ceiling according to me.
Understood. Ms. Lee, how sustainable is the export momentum in China? Do you expect Beijing to intervene through production controls or export policies? Or will Chinese mill continue relying on overseas markets to maintain this utilization rates?
Couple of things. If you're looking at the first 5 year, the first 5 months that you made, export volume declined by 8.1% already. So it shows a downtrend. That's one thing. Another thing is that if looking last year, it definitely was one of the extreme case year. And even though the export volume reached such a level, China hasn't really intervened. So for this year, with a downtrend inside, I don't think the government will be stepping in. I think, and also the other thing is that you're looking at the China's government, their perspective will be very much different from the industrial perspective. They are looking at the overall situation because the steel output declined, export declined, domestic demand declined. So all on the downtrend, which shows that in a way they're kind of coherent. That's why I don't think the government will be looking into too much of this kind of, the couple of years, very high export volume. And the other thing is, for the many, many years, if looking China's steel export volume is always below 10%, around 10% of the total production. So China's steel mills heavily focusing on the domestic demand. Export market will be a very nice add-on, especially when the return is much better than domestic market. But the export market is never the core market for the steel mills. So they will be looking at what is happening in the China's market. And the other thing I want to mention is the steel mills, because of the carbon emission requirements and everything, they already started doing quite serious upgrading or mergers and acquisitions. So for now, I think that the situation, it seems quite dire to some of the countries, but to China, everything's progressing towards a desired target. So I wouldn't think that the overseas market will ever be the core attention for the steel mills. Yeah, thank you.
Adarsh, could you please check is Abdul Halim with us or not? I mean, we want to hear some Middle East sentiments.
Yes, I'm here. Sorry for that because I was having an issue with the with the mic.
No, no problem.
But I can hear you very well. I'm attending from first beginning, so welcome all and sorry for this.
Sure.
Yes, please, Sakina.
So, Mr. Abdul, the Middle East has emerged as one of the most important destinations for global steel exports. However, recurring disruptions around the uncertainty about steel shipments. So, to what extent are these logistics risks already influencing buying behavior in the GCC? Are buyers shortening procurement cycles, diversifying suppliers, or favoring regional producers over imports? And could prolonged disruptions may change steel trade flows into the Middle East?
Yes, actually, this is an important question because logistics risks is no longer theoretical issue for the GCC steel buyers. It's already influencing behavior, but it would describe the impact as a risk premium and procurement adjustment, not yet for structural replacement of imports. There are three feasible changes in buying behavior in this case. Actually, I can see first, many buyers are becoming more cautious and shipment reliability, sorry. The Red Sea disruption forced major carriers or reroutes around Africa, increasing voyage times and freight costs. Although Maersk, for example, and Hapag-Lloyd have recently started restoring some Suez Link services under limited conditions, that means the GCC buyers are not only looking at steel price, they are looking at landed cost, transit time, insurance, shipment, certainty, and so on. Second issue is the procurement cycle. Procurement cycles are becoming more tactical, so buyers are less willing to rely on origin or route or one shipment window. So for a project-based demand, for example, especially construction steel, delays can be more costly than the price difference between two suppliers. So at this case, they are not focusing on the supplier or the origin. So yes, some buyers are shortening purchasing decisions, keeping more flexible booking options, for example, and splitting orders between Asia, regional suppliers, and alternative origins, and so on. Third, regional producers are gaining some advantages, but selectively. When Chinese steel, for example, available at aggressive prices, imports remain attractive. China exported a record of around 120 million tons of steel in 2025, which shows by import, and correct me if I'm wrong about this number, why import competition remains very strong. At the same time, Gulf import exposure is clear. Saudi Arabia imported around 4.6, Emirates, as our friend said, imported around 4.25 million metric tons over the same period. So buyers are not abandoned imports, but they are giving more value to the regional availability when delivery risk increases. So when we have a risk like we are having few months ago, we are especially more value to regional availability. So my conclusion in this, logistic disruptions are already changing the GCC steel buying behavior, but mainly through supplier diversification, shorter commitment windows, more attention to the inventory, and higher value placed or regional reliability. So if Red Sea or Hormuz risks remain prolonged, they could, of course, redirect part of the Middle East steel trade flows toward regional producers and nearest suppliers. But only producers can offer competitive costs, consist quality, and reliable delivery will capture that opportunity, in my opinion.
Okay, thank you so much.
You're
Mr.
welcome.
Muhammad, the European Commission recently reduced safeguard quota across the several product categories, while CBAM enters its next implementation phase. So, which of these two developments, quota cuts or CBAM, is likely to have the greater long-term impact on global steel trade?
Yes, a big topic in Europe for years. In the short term, I believe the safeguard quota cuts will have the sharper impact. In the long term, CBAM will be more structural from what we have seen recently. The quota cuts are immediate and mechanical, and the impact we can see ourselves on the imports into Europe to different main importers in the part of Spain, Portugal, in the part of Belgium, the Netherlands, and it's clear if a supplier loses access to duty-free quota, the commercial impact is very clear. Either the cargo becomes uncompetitive, and we see this in the recent offers to Europe, especially on the flat products, or the seller must redirect it. So quotas will reshape trade flows quickly. They are not going to wait. It's really immediate action on the daily commercial activities that we see, especially for Asian suppliers and commodity grade products. CBAM is different. It is not only a trade barrier, it changes the basis of competition. Over time, exporters will not only compete on price, quality, delivery, as we all know, as main factors of competition, but also on verified carbon intensity, which is a totally new factor and a game change. This will affect investment decisions, definitely, product positioning, customer relationships, and even financing. So it's very complex So I would say safeguards are the immediate shock, if I can call it like that. CBAM is the long-term transformation, which started already. Quotas decide who can enter Europe today. To say it in a different way, the quotas decide who can enter Europe today. CBAM will decide who remains competitive tomorrow.
Understood. Ms. Lee, the reduced European quotas could redirect several million tons of Asian steel into alternative export markets. So, where do you expect these tons to move first? Could Southeast Asia, the Middle East, and Africa absorb these additional volumes without triggering another wave of price corrections?
I think there are several things we need to think about. First of all, European market is not China's largest export destination. Southeast Asia is. And then the other thing is looking at the product structure in general. The products from China to the European market will be more higher-ended products. Whether the other regions will be able to accept or kind of buy such products from China is another question mark. And thirdly, from European point of view, I would say whether EU can afford to do without China imports. Because at the end of the day, of course, you can set bars and you can set all those kind of trade barriers. But at the end of the day, internally, do you have enough do you have enough, to supply yourself? Or you may not have enough, leading to price sharp increases in the so-called like originally a kind of within EU, and then that may be opening doors to the imports from the other countries as well. Because at the end of the day, it's so long as you hit a quota, you can't. It doesn't mean that you can't export, but it means that you need to pay the extra duties and everything. So I think this will be definitely changing the European market into another battlefield. Sorry about the word, but it's literally like that. You're setting up the barrier, you need to think about the consequences or the outcomes. Whether you're doing good, maybe doing good in the near term, but in longer term, can you afford to do so in the long run? At the end of the day, it's more about your own interests at stake. So that's how I put it. Immediately, it definitely will see some of the cargoes also shifting to elsewhere, and maybe a near term like kind of pricing competition among the suppliers. That could be the case, but in the longer term, I think the impact will be far more complicated. Yeah, thank you.
Mr. Abdul Halim, Europe becoming increasingly difficult to access, many exporters are focusing more aggressively on the GCC and neighboring regions. So, buyers in the Middle East already seeing increased offers from Asian suppliers. If imports continue rising, do you expect regional producers to seek stronger trade protection in the coming years?
Yes, actually, Middle East buyers are already seeing more aggressive offers from Asian suppliers, especially from China. The evidence is clear. China's steel export reached a record last year, around 120 million tons, and the GCC market absorbed significant volumes, either in Saudi Arabia or Emirates as well. So for buyers, this creates opportunities. Opportunity, more offers, more negotiation power, and lower import parity. But no regional producers, it creates margin pressure, especially in commodity long products or standard flat products. So yes, if imports continue rising, I expect regional producers to push for stronger trade protection. Not necessarily blanket protection, but more targeted measure, anti-dumping cases, quality standards, origin controls, and so on. So my view is the GCC will try to balance two objectives, keeping steel competitive for construction and infrastructures, while protecting strategies industrial capacity. The key question will not be imports or protection. It will be how we maintain open supply while preventing unfair or disruptive trade. This is my view. Thanks.
We talked about CBAM. So which producing regions are currently best prepared for CBAM compliance? More importantly, do you believe carbon intensity will become a decisive competitive advantage in steel exports by 2030? If all of you could give a brief overview on this. Yeah, let's start with Ms. Lee first.
Thank you. If you look at the CBAM, I think the topic has been in the market for so long, and more concrete progress this year. And a couple of months ago, actually, I attended another steel forum in Singapore. We were discussing about this. China, I would say, definitely is not ready. It's ready in its own way because it already started doing a calculation about the carbon emission from the whole steelmaking process. But whether that calculation aligned with the CBAM requirements, whether it's convertible, is a very big question mark because apparently European Union view China's steelmaking process in a different way, very much a different way from China itself. And then their understanding about the carbon emission per ton steelmaking is way higher than what China calculated. So, if we define like who is ready, I mean, from what perspective, like China definitely trying to make itself aligned, but whether European Union accept that, that would be the different matter. But if you look in the other countries, India, it's the same thing, right? So long as we're using the thermal power, we can't say that we're ready. So unless you are using clean energy, but how to convert and how to make it workable or kind of within the calculation formula of the EU is another question. I think maybe European steel mills are the best prepared, but unfortunately the CBAM doesn't apply to them. So yeah, that's my answer. Thank you.
Mr. Abdul Halim. I think he's not audible to us. Mr. Mohammed, if you could throw some views on this.
Yeah, indeed. As Ms. Lee said, it's a topic in the market for a long time. But talking about the regions that are best prepared for the CBAM are, I think those are the with the stronger emission monitoring already, cleaner power systems, electric arc furnace capacity, and experience with the environmental reporting. Long ago. And definitely Europe is ahead because it already operates under those frameworks. But this is not the interesting part. But we see on daily basis that some producers in countries like Turkey and the GCC, Korea, Japan are also moving seriously, especially those targeting premium export markets. But many suppliers are also still underprepared, not necessarily because they cannot reduce the emissions immediately, but because they lack verified installation level data. For example, for buyers, documentation is becoming almost as important as the physical material. That's also another challenging part. So by 2030, I believe carbon intensity will become a decisive advantage, especially for exports into Europe and for premium customers in automotive, appliances, and major infrastructure. It may not replace price completely, but it will become a qualification filter. In some tenders, low carbon steel will be a marketing point. It will be a condition to participate.
Mr. Mohammed, with exports facing increasing trade barriers, where should Indian mills focus their export strategy? I mean, you did told us that flat products are traded more globally, but should the emphasis be on premium flat products, value-added coated steels, pipes and tubes, or emerging markets beyond Europe?
I missed the beginning of the question. We talked about Indian mills, I think.
Yeah, where should Indian mills focus their export strategy?
Yeah, that's interesting as India is a big part of the world and a big player in that sense. And the Indian mills should definitely avoid competing only on a commodity as commodity exporters. India's strongest opportunity, I believe, is to move up to value chain. This is very important. Premium flat products, coated steel, pipes and tubes, and project-related steel for infrastructure and energy, those are more attractive than simply pushing basic hot-rolled coil into oversupplied markets. That was our very start, the oversupply. So India also has a natural advantage in markets where reliability, relationship, English language, also commercial culture, and financing flexibility matter. And we see this a lot in export markets for India, like in the GCC, Saudi Arabia, UAE, and other countries. And a lot of proofs can prove this fact with a lot of Indians are already in those regions achieving huge success there. Europe will remain important, but it will become more difficult because of safeguards and CBAM, again, as we discussed a few minutes ago. So Indian mills should build a balanced strategy, selective Europe for value added and compliant material, the GCC for infrastructure and energy projects, maybe also Africa for long-term growth, and Southeast Asia, where quality and delivery reliability can differentiate them. So, if to mention in one message, India should export value, not just volume.
Yeah,
Thanks.
obviously, China and India remain the two largest pricing influence across Asia. How do you see this competitive landscape evolving? Can Indian mills differentiate themselves through quality, sustainability, and reliability rather than simply price?
Uh, Looking at the question, actually, there are a couple of things I want to highlight. First of all, if you're looking at China's steel exports, it's a large variety of products. Whereas, to my limited understanding, India is more focusing on flat steel. So definitely, if India want to compete against China, flat steel will be one of the focuses. But how competitive Indian mills are, I'm not so sure, because after a few decades of development, China is definitely very competitive in the quality, in the price. Another thing actually I want to highlight, because I've been to India for the past couple of years, once a year at least, I definitely can see the potential of the domestic economy. This actually reminds me of China back in 1990s or early 20s. Domestic market is huge. Domestic market having the potential. So my sense will be, of course, export market is important, but similarity of the two countries, China and India, you have a huge domestic market to explore. And China steel mills actually managed to grow is because it has been setting a solid footing on the domestic market first. So instead of like kind of competing against each other or with the others in the limited export market with all the geopolitics uncertainties and all the trade barriers, do not think that trade barriers are only affecting the China steel mills. It's affecting all the others, right? So EU built up barriers against all imports. US the same thing. So I would say instead of like kind of looking at the limited market share, outside, the first thing will be looking inside to see what the domestic market will need and get yourself ready and focusing on the domestic market because that is a huge market you can't afford to lose. Whereas regional markets or kind of export markets, sometimes you can do without. Yep. So that's my answer. Thank you.
Is Mr. Abdul Halim with us?
Yes, yeah, I am with you.
So India's steel exports to the GCC have steadily increased over recent years, and it is supported by infrastructure expansion and closer economic ties. So, which Indian products currently enjoy the strongest competitive advantage in the Middle East? And are the product gaps where Indian suppliers could further increase market share in the GCC?
Yes, I believe Indian suppliers are gaining visibility in the Middle East, but their advantage is not across all products equally. Like Mr. Muhammad said, the strongest Indian advantage today is in the semi-finished steel, especially pellets, where Indian mills can serve the GCC rolling mills when regional supply is tight. So recent GCC trade reports noted that Saudi buyers, for example, taking significant pellet volumes from India, including large cargo. So the second area is hot rolled coil as well, flat products, particularly where buyers need alternatives to China, Japan, Korea, or Europe. Indian HRC is becoming more relevant because Europe is tightening axes and Indian mills are building scale. This is in my يعني, my view. So for long products like rebars, Indian can compete, but advantage is more selective. GCC producers are strong in rebar nowadays. So Indian suppliers with mainly when there is a price gap, urgent demand, or temporary supply shortage, they can compete. But normally the local producers can also compete. So the bigger opportunity for India, in my opinion, is in product gaps, coated steel, plates, structural sections, pipe grade steel, for example, wire rods, and project specific steel for infrastructure, energy and industrial construction. For example, for the solar system steel, it will be very important in the next decades. So India should also focus on that. There are areas where GCC demand is growing, but local production depth is still uneven. So my answer on these specific questions, India's strongest current advantage is in pellet and selected flat products. But in the future opportunity, India has to focus in higher value, like Mr. Muhammad Sami said, project-linked steel as well. If Indian suppliers can combine competitive pricing with consistent quality, certification, and reliable delivery, they can increase market share significantly in the GCC over China on the few next years. Thanks.
Yeah. So we also talked about the trade policy, and over the last 18 months, we have seen an increase in anti-dumping investigations, safeguard reviews, and import restriction across multiple regions. So, do you all believe the industry is moving toward a permanently fragmented global steel market? And which upcoming policy decisions should exporters monitor most closely over the next 12 months?
I believe many countries now are going to have these rules, but it will not remain too much because uh, of the infrastructure, the mega projects in the area, they cannot accommodate locally by the local producers. So they have also to make some softening, let us say, some flexibility in importing and exporting rules. This is my opinion. So within the next 12 months, I believe it will be reduced, all these tightings.
Miss Lee, your view on this?
Trade barriers actually, when we're looking at the steel market, I would say this is not a standalone situation. It's more to do with the geopolitics uncertainty,
Yes.
deglobalization, deregionalization. So all these kind of things, I think, are very much depending on the countries, what they put at their heart, like, protectionism and nationalism, all those kind of big words, but they will be reviewing their national interests. So to some extent, I agree that if they review the situation, realizing that the domestic supply will not be able to fulfill their demand, then the trade barriers may be lowering down. So I think it will be on and off all the time. For example, like Middle East, if let's say the war ends, all of a sudden you have all this kind of reconstruction of the infrastructures and the property market and everything. Middle East itself will definitely not be able to supply all the steel, so it definitely will be opened up to the other market. Same with EU, even though we are talking about all this kind of, the CBAM, the quota, but at the end of the day, I have to emphasize that they have to review how much they can sustain themselves. So I would say for the next 12 months, with all the chaotic situation globally, I think all those kind of things will be on and off all the time. Yeah, that's my answer. Thanks.
Mr. Mohammed, your view on this, please.
I believe yes, the steel market is moving toward more permanent fragmentation, not full deglobalization, but more regionalization. In the past, I like to compare historically. In the past, steel trade was mainly driven by what we all know: price, freight, and availability. Today, and our panel discussion is a proof for that. Today, we must add safeguards, anti-dumping, CBAM, sanctions. We can add more local content rules, origin traceability and logistics risks, which was one of the main topics today, as Mr. Hussam talked today. This makes trade more complex and less fluid. For exporters, the key policy decisions to monitor over the next 12 months are, I believe, EU safeguard implementation, CBAM enforcement and default values, new anti-dumping cases in emerging markets, possible trade responses from countries receiving redirected Asian volumes, and any US or EU changes linked to green steel or strategic industries. The winning exporters, I believe, will be those who treat trade policy as a commercial function, not only a legal issue. You need a market access strategy, not just sales strategy. In the past, sales strategy was enough, but this is not the case today. You need also a market access strategy on short term and long term as well. So, if to say it in one concluding sentence, I would say steel trade is no longer only about price and freight. It is about access, compliance, and resilience as well. Thanks.
Noted. So I would like to conclude by asking each of you a forward-looking perspective. Looking ahead to 2027, please identify one market you are most optimistic about and one major risk that could disrupt global steel trade. Very briefly, all of you. Mr. Mohammed, we can start with you first. followed by
For 2027, I'm most optimistic about India and more broadly infrastructure-led emerging markets. India has a strong domestic demand momentum, capacity expansion, infrastructure spending, and manufacturing growth. Around India markets in the GCC and Africa also offer structural opportunities, uh, especially in construction, energy, and logistics infrastructure. The biggest, if I move to the biggest risk, is what we have just discussed: fragmentation, the trade fragmentation, combined with what we started also today, the oversupply. If Europe, the US, and other regions continue tightening access while Chinese and Asian volumes seek alternative destinations, we could see strong pressure on price in the Middle East, Africa, and Southeast Asia. Then add logistics disruption or geopolitical tension, and trade flows can change very quickly. So my optimistic view is demand growth in India and emerging markets, and my risk view is that excess supply and protectionism create a more volatile and fragmented global market.
Yeah. Mr. Abdul Halim, your view on this, please, very briefly, as we are running short of time.
Yeah, actually, I fully agree what what Mr. Muhammad said. It's almost the same. I can see also India is the market. Then comes the GCC and Africa markets as well because of the infrastructure and mega projects going on in the next few years. So we have to focus on that. For the risks as well, it's the same like Mr. Sami said. So nothing new to add, yeah. Thank you.
Okay. Miss Lee, yeah.
Yeah, I mean, if you're looking at one market, if you're looking at the volume, I totally agree. India, for the past 2 years, India is forever progressing towards the 300 million tons per year target. And I heard about the number firstly back in 2004, but nowadays it's definitely materializing, which is very encouraging. That's talking about the volume. But then if we're talking about the quality, I definitely feel that China is doing something about the upgrading, about the capacity curtailing. That to some extent will be lessening any pressure or kind of threat felt by the other countries. If you're looking at the major risks, actually, I would say confrontation. So either in the form of trade barriers or in the form of the war itself, that was the biggest risk because that will be disrupt all kinds of trade, not only about steel, but all the kind of trade flow will be disrupted about the logistics, about the supply, about the concern. And then it will be building up the anxiety among all the countries. And then you never know what this will be triggering. So that's rather concerning for 2027. Yeah, thank you.
Thank you. Thank you, everyone. Over to you, Adarsh.
Thank you, Ms. Selina. So we have one question from our attendee. Can you please put your insights on China growing influence over seaborne iron market? Let's start with Miss Lee, if you please.
Sure. Iron ore market is very highly concentrated. We definitely can count the top few producers. But China, because of the steel output declining, demand declining, then China definitely having more leverage. And also, do not forget about Simandou, because Simandou, the offtake deal or the market share for the Chinese producers or investors has been huge. So with a growing supply from Simandou, China will be having better leverage. And also, on the other hand, because China's overall demand will be declining as well. And also China having a large port inventory number. Nowadays, we're looking at 175 million tons, that would be sufficient to last the steel mills for quite some time, enabling, the whether CMRG or some other steel mills to bargain for way better prices. So, yeah, that's my answer to this. Thank you.
Can we have Mr. Hussain for the same question? I think we are not audible to Mr. Hussain. Mr. Sami, what are your views on the China's growing influence over seaborne iron market? Maybe no, sir.
Thanks for the question. And mentioning China is very interesting to what we are doing today from Asia to the Middle East. I would like to make it clear on my point of view regarding China. I believe China will remain the most important pricing reference globally. This is an important topic and that we have been discussing even within the EU discussions and also our Middle East meetings. It's still the most important pricing reference globally till today. Even when Chinese production declines, exports can remain high if domestic demand is weak. So the key for other regions is not only China's production level, but the export allocation by product and also by destination. And as Ms. Lee mentioned, there is a lot of diversification. When you look at the products that are being exported from China, you are not talking about a focused product. We are talking about a very diversified product portfolio, talking about flat or long. And looking into the numbers and the statistics, look at the destinations. It's also diversified, apart from Europe, of course. That's what I can say about China briefly. Thanks for the question.
Thank you.
So there's another question which has been asked by one of our attendees, and it is quite an interesting question. That is why again I want to throw this question. I know we have stressed a bit, but I guess because the question is good, so I thought of taking up this question as well. So one of our attendees is asking, how do you see the balance between infrastructure-led demand and manufacturing-led demand evolving globally?
Can you please repeat the question?
Yes, sir. So one of our attendees is asking, how do you see the balance between infrastructure-led demand and manufacturing-led demand evolving globally? So, I mean, my understanding about this question is he want to understand how will, the ecosystem will create a balance between the infrastructure-led demand and the manufacturing-led demand, and how will it evolve on a global level? So, even Sakina, if you can also take up this question, being from Begment.
So, like we discussed, so infrastructure-led demand is a bit slow if we talk about the Indian market, but we are seeing a manufacturing-led demand evolving even globally, not just India, but globally. And I think we discussed that, demand is again a very good factor if we see the price movements and everything. And I think Mr. Mohammed would also can add a few points on this for Indian market, I feel.
Yeah, globally, manufacturing demand I see it is not balanced with the steel production capacity that we have today. Demand is growing in some regions, so of course, especially in India and infrastructure-led emerging markets, but it remains weak in Europe and under pressure in China because of slower construction and property activity. So the issue is not only total global demand, but regional mismatch as well, which we cannot ignore. So some mills are producing more than their domestic markets can absorb. So excess volumes move into export markets and pressure prices, which is very logical, and we see it historically over the years. In my view, the market is still more supply heavy than demand supported. Until manufacturing and construction demand recover more broadly, steel prices will remain driven by competition, inventory, discipline, and trade flow rather than only production costs, which is an old mentality, according to me today, to just say that it's production costs. I hope this answered part of the question.
No, that was really well answered, Mr. Mohammed. So over to you, Adarsh, now.
Yes, sir. So, just a second. Let's wind up this session with wonderful session with this, sir. Thank you so much, Ms. Sakina, for moderating such an engaging and insightful discussion. I would also like to extend my sincere appreciation to Ms. Hongmi Lee, Mr. Hosham Abdel Halim, and Mr. Sami Mohammed for sharing their valuable perspectives on the evolving global steel landscape. Today's discussion has reaffirmed that the future of the steel industry will be shaped not only by domestic growth, but also by international collaboration, informed decision making, and a deep understanding of global dynamics. On the behalf of organizing team of World Metals and Mining Summit 2026, thank you to our distinguished speakers and all our delegates for joining us. And I would request you to stay tuned for our next session that will be begin soon. Once again, thank you so much.
So just an announcement to make for all the attendees. The next session will begin at 1 p.m. It will be on a global manganese ore outlook. We'll have a feature speaker, Mr. Gang Xia from China. He's a CEO of Million Link Investment China Limited, along with an analyst from Questro and panelist from Metals by India as well. Thanks a lot. Thank you, Ms. Hongmi. Thank you, Mr. Mohammed, and thank you, Mr. Abdul Halim. And thank you, Sakina, for moderating it so well.
Thank you.
Thank you very much
Thank
for the
you.
interesting session. Thank you.
Yeah, bye-bye.
Thank you. Thank you. Thank you.
Bye,
Bye-bye.
everyone. Thank you to the panel. Thank you, Adarsh.
Yeah.